Thank you, Aditya. Before I get started, thank you for a very warm welcome. Yeah, and lots of nostalgia, when we sort of started it out, and I was looking at the richness of the panels and the wide coverage for the conference that you've put together. So I'm sure it's been a great experience for people who are a part of it. And I agree with you. I think when we sort of started out, none of us believed or had an inkling of how complex or how vibrant the space was going to be, and just the sheer number of options available for investors and so on and so forth. So great to be here, and good evening, everyone, to all the attendees and fellow panelists. As Aditya mentioned, in the closing session. The topic is very interesting. Finding alpha through non-correlated and niche fund strategies and sectors. And I think it's interesting because it's perhaps the beginning of the year, calendar year 2022. It's perhaps the single most important question occupying investors' bandwidth currently. If I were to just take a minute to set the context here, most of it is known, but all of us have a significant COVID memory, and I'm using the word memory with a big hope and prayer that the worst is behind us. But 2 years back, when the crisis really broke out, globally, the central bankers and governments in India as well, to whatever extent that we could, pulled out all stops, throwing in their monetary and full fiscal firepower to contain. It was the wise thing to do, but let's look at what it did to the investing community and investors. First and foremost, where the world was already stacked against savers in the wake of the loose monetary policy since GFC, it became even tougher. So unless you went down the curve in search of yields, it was all through negative real returns in highest quality credit globally. In India, very anemic, and adjusted for inflation, clearly negative returns. On the other hand, for risk assets, for equities, with the benefit of hindsight, it sounded like a very heady cocktail of low rates and therefore low discounting rates, and therefore the right environment for risk assets and prices. But at the time, it wasn't so apparent, especially with all the uncertainty in real economy around jobs, income growth prospects. This is, you could have gauged that with investor cynicism that came by with every successive rise. That was then. And now we're getting into, as we are here in the beginning of this calendar year, I think we are perhaps getting into the next big phase of volatility. More true globally, but India not insulated at all, whatever be the optimism and about the medium-term growth prospects. In fixed income, again, the one which is perhaps going to be a little more difficult to navigate. Investors now have to navigate and contend with rising rates, which obviously has an adverse impact on prices with significant mark-to-market impact. And the dynamics on the discount rates also has a significant downward pressure on risk asset prices from a conceptual point of view. So beginning of the year, we've had a great bull run party on equity assets with all that's happening on by global central banks in terms of the rates, in terms of the pace of quantitative easing, even contraction of balance sheets, headed for a huge amount of volatility. And I think in that context, today's session is extremely topical. Looking for low correlated, or I don't know if it's really possible to have a completely non-correlated, but perhaps a low correlated, and on a risk-adjusted basis, a superior return profile. Before I sort of get panelists in, if I were to look, at it as an investor, from well-established active investing, I'm looking for two things. I'm looking for skills, and I'm okay to compensate for identification of opportunity. But more important, I also want to understand and be comfortable with what goes inside the black box and how the risk and liquidity is managed. So therefore, on the topic of generating superior risk-adjusted returns, compensation for skill and opportunity spotting, but also being comfortable with the risk management policies and liquidity management policies. I just got a few last minutes of the previous session, seemed very exciting on crypto and NFT, and I think a panelist spoke about how out of 45 billion, 2 billion was capital and 43 billion was capital gains. A fantastic sort of, I don't know how much of that is going to get repeated, but seemed like a fantastic investment opportunity with hindsight. Today, we're going to be focusing on a few areas, with the experience of the domain specialists that are here today. And we'll start with the fixed income space first. I can think of two dimensions. There are two obvious dimensions that come to mind when you look at increasing your returns. Duration, which is going to be not an easy one given in a rising rate environment. And second, managing credit. In the space of performing credit, Vineet, through Vivriti and through your previous experience with IFMR as well, there's deep pocket of experience that you have. It'll be great to hear in terms of how do you look at generating alpha, what's the target universe, how do you go about identification of opportunity, so on and so forth. So with this, Vineet, I'd like you to open the discussion on how to tackle investors looking for superior return in performing credit space.
Thanks, Arpita. Our work at Vivriti has been to map the fixed income space for the last 5 odd years with the objective of delivering value to investors. Now, to dive a little deeper, India has a highly skewed debt market, more so than most developed economies on debt, where AAAs and AAs corner most of the liquidity. To put things in perspective, in the Indian market, which is roughly around $2.5 trillion, 80% is the government, 20% is corporate debt. Of the 20% corporate debt, 40% is 10 issuers, right? Of the balance, 60%, again, 56% is AAA and AA, right? So that's the extent to which the market is skewed. It's insane. And as a result, simply because of lack of liquidity, pricing gets driven up, right? Now, how much does pricing get driven up? If we go by domestic rating scales, the spread between a AAA and the government of India is, let's say, 40 basis points, right? The spread between a single A and the government of India is around 5%, and the spread between BBB and the government of India is 8.5 to 9%, right? And these spreads have not really changed. I could have done the same exercise in 2015 and arrived at the same numbers. What does this imply? Is that there is a significant amount of return available when you go down the rating scale, right? But having said that, what about risk? Right? Now, to assess risk, we have pretty sturdy data. We have transition matrices that have been published by rating agencies for the past 20 years, right? Which tells us that what is the likelihood of default for AAA, single A, BBB, and so on, right? Now, if I take CRISIL AAAs have never defaulted, right? CRISIL single A's could have a probability of default of under 1%, and CRISIL BBBs would have a probability default of anywhere between 2 to 3%, right? So look at the equation. We have single A's that are delivering 400, 500 basis points above what is risk-free, which is government of India, but the delta risk is less than 1%. We have BBBs delivering 8 to 9% over government of India, but the delta risk is 2 to 3%, right? And that's when it becomes very, very clear. Why are investors not being able to capture this alpha, which is essentially the premium available of return over risk, right? Because it is a tough market to get into. It's a tough market to get into. India has 40,000 corporates that are rated BBB minus and higher, or taking a revenue of, say, 100 crores and higher. This is just registered corporates on Ministry of Corporate Affairs, right? Now, how does one reach that kind of a mass of companies? How does one correct for governance risk? How does one correct for diligence? How does one correct for data? How does one assess private companies? These are the challenges in this market that have kept investors away. But is there alpha for the brave-hearted? Absolutely.
Thank you, Vineet. Yeah, no, I agree with you. I think the risk premiums that you spoke about, there is a significant mispricing, and I think, and if you're an investor were to also construct a well-diversified portfolio of, a portfolio of performing credit, and especially in the environment that we have, it will perhaps take care of, with the visibility of return, will take care of a lot of, portfolio objectives. Thank you. Vijay is not here. I think we'll wait for him to join in. Hitesh will this is for you. And it's very interesting, the way alpha is defined is subject to significant interpretation. A large section of investors still believe that outperformance of the versus the indices actually equals alpha. We all know that wouldn't be the case. Alpha obviously needs to be seen in context of beta or the market sensitivity of the portfolio as well. I understand your expertise lies in, and your belief is that the security selection is actually the primary source of alpha in a bottom-up, long-only portfolio construction. How do you manage to achieve this? And the general belief is obviously it's going to be very, very highly correlated to overall public market sentiment and so on and so forth. So maybe I'm making it tougher for you, but a few insights in terms of how.
No, it's actually a great question. Actually, on the contrary, I am delighted about what has been happening in last few years in India. So as I think of doing some alternative assets and all in my previous organizations in Birla or in Edelweiss and so on, what has happened is the way Indian markets have evolved over the period of time. For somebody like me who is trying to find a balance in the portfolio, what has happened in recent years, now suddenly we can invest in e-commerce, we have been able to invest in tech, diversifying market more for around more than 25 years. So our markets are getting more and more broad and more balanced. So that is a plus. For somebody like me who plays in a very narrow asset class, like Rajesh, we don't do much of long short here and long oriented. So our idea is to generate alpha essentially through the stock selection, and in our preference has been to be a bottoms up stock selection mindset. So so alpha generation comes essentially to our mind. It's not stocks that we buy, it's the businesses that we buy, the typical long only fundamental oriented mindset. And inside of that, it has been a boon to step away from classic risk management that takes place in every mutual fund and every fund for that matter, and just to focus on quality of the business and what we can buy there, and that becoming a source for us to the alpha generation. And so what has also happened is the number of companies in India that have reached scale, reached grand sizes, they have become global players, right? And then they in turn attracting much more investment from around the world, becoming more stable. That again allows us, to all those who are more of risk management mindset to come to India and have a more balanced portfolio. But from our perspective, we are just delighted that the way Indian markets are growing and expanding with number of listing is that somebody like us can also have less to worry about in much more correlated markets and find very independent sources to make money from.
Right. If you want to make it a little specific in terms of, although I can think as you were saying, I could think of many companies whose corporate earnings profile will not be depend on what the Fed governor does, but the price performance in some extent, in a short term will get impacted. So maybe if you could make it a little specific in terms of,
yeah. So you'd be right again. So the point is, for example, if you, we think of stocks and what is the correlation of the stock price versus Nifty or Sensex or whatever index one wants to do that exercise with. But actually think of India, many of India's great companies, right? You think of Asian Paints and you think of Pidilite and you think of TCS and Infosys and HDFC Bank and so on. Over the period of last 30 years, what kind of events have actually impacted them? I mean, barely any. I mean, over over the medium and long term. Short term, we all get we go back to the COVID onset stock prices, and we realize that in that March, April of 2020, suddenly everything crashed, no matter how good it was. But just see how quality companies have come back. But the point is that if you have a 5, 10 year, 15 year, 20 year, 30 year outlook, I mean the companies that I named, and there are dozens more which have not been kind of correlated with level of inflation in India or volatility or couple of mini forex crises that we had and exchange rate movement and so on, and also for that matter very low GDP growth phases. So the extraordinary business is what we kind of focus on, and that becomes our pathway to create alpha. Now, the only point I was making previously was that the number of companies available, just the the suite from which you can pick something, is becoming wider and wider and wider in India, which is great. And I think it is going to be a virtuous cycle in the sense as more and more companies, Indian companies, say for example, become more than 100 billion market cap, 50 billion market cap, we are increasingly getting more and more attention of the global funds as well. So, so to answer your question, it is secularity, the quality of the businesses that kind of becomes a source for to be able to diversify from many different companies. We are, take Nykaa for example versus any other banking company, or take an oil company versus large insurance players which are getting listed now, so on and so forth. So there is the advantage of diversification available.
Yeah, thank you, Hitesh. I think the operative word is the investing horizon for an investor. The longer it is, I guess the correlations tend to work out a lot better. Next question is for you, Rajesh. And I was remembering the conversation that we had where we spoke about how globally hedge funds, which is an all-encompassing product category, is so much bigger than the active fund universe. In India, it's exactly the opposite. The liquid alternatives or long shorts are a small fraction of the 37 lakh mutual fund assets and so on and so forth.
Absolutely.
But it's an exciting asset class, has got early on the fancy of a lot of investors. And if you were to look at broad brush, two buckets there, absolute return strategies of fixed income oriented, and specifically for you where the expertise lies is on the equity oriented strategies. So it'd be useful to know how do you go about spotting opportunities? What is that investors should expect when looking at a portfolio strategy like yours?
Sure. So allow me a few minutes, because I find it a challenge to kind of articulate what I really represent. So just give me a few minutes.
Take your time. Take your time, no problem.
And Arpita, I think you laid out the road, where we are as far as market cycles are concerned, very, very clearly, because I think sometimes when I look around, I feel people are not appreciative enough of the world that we are living in. The laws of finance and economics have changed thanks to this extraordinary monetary stimulus. And I think once the genie is out of the bottle, it has implications. It's not easy to put back in. And it would have, I think the asset correlations are going to get more and more tighter. So I think the need to step away from that and generate uncorrelated returns or true alpha is even more important. Okay, having said that, I represent ITI Long Short Equity Fund. We are a fundamental long short equity fund, and our objective, simply put, is to generate asymmetric return. What is that? Basically, like I said, we are in the equity space. Equities is one of the best asset classes, which when you compare it with India, the BSE Sensex, which started about at 100 in 1989, is 60,000 or thereabouts. That's a 16% CAGR over 42 years. Or even if you look at the United States, 120 years of US history, equities have been a phenomenal wealth generator. But how do you participate in this best asset class with risk-adjusted profile, especially given the context of where we are? Asymmetric return profile, which is if the markets go down, we protect downside. And as markets go up, we generate an equity type return, right? So, okay, I've said that. How have we done on those parameters? We are a 3-year, 10-month kind of a product. Of course, I've been a long short equity fund manager in India for the last 14, 15 years, and I have a history of that performance. In that last 3 years and 9 or 10 months, there were 2 episodes when we saw declines. One was during the IL&FS crisis, second was during the COVID crisis, right? So during the IL&FS crisis, markets fell 11%, we fell about 2%. And during the COVID crisis, the markets fell from top to bottom 35 to 40%. We actually made money during that period. That's a significant value add if you can participate in equity markets and can protect downside. And that's really what we do. And how have we done on the second parameter, which is to participate? Our gross returns in that 3-year, 9-month, 10-month period is about 16% CAGR. So we are making equity type return. So that is really what we are trying to do, generate equity type returns and here protect downside. So why does it matter? I mean, why does protecting capital matter? Now, I kind of articulate that in two ways. One is, imagine if you were in February and March of 2020, markets fall 35, 40%. Let's say it falls 30%. The index has gone from 100 to 70. Now the index needs to come back to a 50% return to break even, roughly thereabouts. So that is a significant protection of downside that you have taken. I'll give you another example. Go back to 2008. Markets fell, I think on the calendar year basis, 55%. Right? We were there during that time. We were there for part of the year very consciously. We fell 1.5%. Right? So if markets fall 55% and they took 6 or 7 years to come back to principal, right, to your 100 rupees. So that's really when you would feel the need to protect downside. You know, I think one of the principles that is underappreciated in the investment business is that it is a necessary condition that if you want to compound wealth at an attractive rate over the long term, you have to take care of your downside. There's a good reason why Warren Buffett says, rule number 1, don't lose money. Rule number 2, never forget rule number 1. I think it's the mathematics of decline. So I think that's one damn good reason why this is an asset class by itself. As you correctly pointed out, it's a $4 trillion business globally, but it's really at the ground floor as far as India is concerned. So, I think those are some of the points that I would make. And I think the next question that it needs to be answered is, do I need this strategy today? And I think you correctly pointed out the world we are in. The real rates of interest have been negative in India for the last 3 years. So when we talk to investors tell us that, look, I'm not really making money in fixed income. And equity markets, given these are all artificially engineered markets thanks to macroeconomic policies, I'm not comfortable putting in money in the equity markets. So how do I navigate this territory? The answer is a long short equity fund like us. So the relevance of our strategy and asset allocation as an asset class is even more today than ever.
Sure, Rajesh. Thanks for a very expansive sort of a discussion on that. You know, in an environment where there is significant concern on downside volatility, so there's something that has the promise to protect your volatility and on the upside participate in equity like returns, that sounds almost magical, but I'm going to make your life difficult and ask you what goes in the black box to create this asymmetric return profile to the extent that you can talk about, or it's easy to articulate. Yeah.
So we are really an open book. So this is actually a skill job, right? There's far more greater intensity required in managing a long shot. And I think the skill required is, as Hitesh would do, which is bottom-up stock picking. There is a long book that you have to craft, if I can call it that, which is, pick up businesses which you think are going to participate in the equity markets on a strategic basis and tactical basis. This is how we do it. And then there is a short book, right? And if you ask me, I think this is one of the best times to have a short book, right? And why is that? Because today, more than ever, some people would say this is the most disruptive environment for businesses ever, right? There is so much disruption that's taking place. So what we are noticing is there are several businesses that are getting derated, right? So whether it is the automobile business, electric vehicles is derating those businesses, whether it is, supposedly there is derating that's happening in banks thanks to fintechs, whether it's broadcasting, people are worried about whether the advertising dollars are getting eaten away by other media platforms such as Facebook, etc. I mean, so I think this is a good time, and we are seeing a lot of that derating process happen in several businesses. So it's a great time to have a short book. But also, as cycles get shorter, I think cyclical plays, over-leverage plays, misgovernance opportunities become all the more important for us to have a short book. So there is the skill set in identifying longs and the skill set identifying in shorts. So this is the bottom-up skill that you bring to the table. But there's a top-down skill that you bring to the table as well, which is we are not macro forecasting, but we are always looking out for the big risk that can disproportionately impact markets. So when it was in February or March of 2020, we figured that COVID is a big risk which can disproportionately impact markets. As we speak today, I think people would say that inflation, particularly in the developed nations, and therefore the reversal of monetary policy is a significant risk to the market, because we don't know how much would be the extension of this tightening that could take place and what impact it would have on risk assets. So we would monitor from a top-down perspective these large impacting.
Sorry, I'm sorry.
So large impacting events which can disproportionately impact markets, and from a bottom-up, it would be to identify long and short companies on a fundamental basis. So it's very simple. There's no magic sauce really.
Thanks, Rajesh. It was very useful, and I completely agree with you on this being a extremely skilled sort of a job. It's very difficult at times for fund managers to get the long end right and being able to get both long and short end right, which I think is something that your sort of performance track record sort of corroborates is amongst the highest skill jobs if ever. So, so the first set of questions really was about, spotting opportunities, and, so Vineet spoke about, the risk premiums and the asymmetry of risk premiums that sits in within BBB versus the other credit, and Hitesh about the secular companies and their earnings profile divorced from whatever happens in globally. But I think the second set of questions, and I really wanted to, and all of you have sort of referred to that in passing, but given that this is yet to become mainstream, and even with the most sophisticated investors as well, there's a journey that they will go through. I specifically wanted you to focus on the risk management side of it, and how do you sort of ensure that on an aggregate basis, for example, when we spoke about that the default rates across these have been largely contained, but on specific to the security selection, what is it that, and I'm sure there's a lot that goes behind to ensure that the investor experience not compromised. So largely from everyone, starting with how do you anticipate more and handle risk?
So Arpita, our work on risk management is a combination of how we use technology and how we use people. This is not a business where we can completely eliminate people, although we would love to, but that's not the way this business can be run.
Sounds dangerous. Eliminate people, did you say?
Yeah.
Okay.
That's the fintech language nowadays. So how do we do it? One, we track the digital footprint of companies very, very closely. And here I must admit that that 5 years back, our model would have been very, very tough to execute. But given the advancements of technology, it's a model whose time has come, where right from periodic disclosures to public information on any organization, public information on the sector, ability to track account level payments through bank accounts, GST payments, ability to track pension fund payments, ability to track legal cases for and against a company on a digital platform, ability to track currency of payments and delays, right, on a very concurrent basis, forms a core part of our risk management that gives external feedback without dependence on the company, right? Having said that, this is by no means enough, because we're dealing with a complex animal, which is an enterprise. It's not an individual that can be reduced to 5 data points. It's an enterprise which is complex, and therefore a physical diligence forms a very core part of our assessment. We spend 2 days with each and every company. Our team visits 9 states a month. Our team visits close to 250 companies a year, which is a day in the field and a day in their office. And it's a 360-degree assessment of the founder, their ambitions, motivations, the CXOs teams, the technology system, their lenders, their equity investors, their directors, independents, as well as their customers, right? It's a complete 360 assessment, which depending on how well we do it initially, can build a lot of confidence on the quality of the enterprise, especially governance, because the single biggest risk that we have to iron out in this process is governance risk. That once we cross that barrier, the rest of it is much easier, right? The third part is how we invest in now transformative technology, which is going beyond just a digital footprint. For example, how do we rate a company? How do we score a company? How do we peer assess a company? How do we forecast their numbers? There's a lot of work happening that has happened and continuing to happen as we build our digital models towards this as well. The fourth is portfolio management. We can do everything under the sun, but that can be an event risk. You had alluded to this when I spoke last time on diversification. Statistically, numbers of 0.5%, 1%, 2%, 3% look great, but that implies that we have built a large portfolio. We cannot have a fund with 5 exposures, which is possibly true of many structured credit funds, and claim that probability of default is low. It doesn't work that way, right? So we strive to bring fairly extreme diversification across funds for the credit fund space, typically less than 4% at a security level or ISIN level. That, to our mind, is then starts making the conversation on PD more statistical rather than very unique and entity based, right? So sectoral diversification, entity diversification is important. This is pillar number 4, and finally the 5th pillar is continuous monitoring, right? Every quarter, every company goes through a re-rating. Every quarter, every company goes through a reassessment, and every quarter we also re-establish contact with the company to understand where they are. And this is very rigorous and always and constantly gives us a sense of where we are with this organization, right? These are the five pillars for us from a risk management perspective.
Thanks, Vineet. Very reassuring, and I sort of completely agree with that. I think divorcing diligence from what you get to hear from the company and strengthening it with as many data points to sort of. But if I were to just ask one more question, because I think the Six Sigma event for the kind of portfolio of companies that you have, especially is financial services and actually balance sheet companies and MFI and so on and so forth, they would have got stress tested at the peak of COVID. So what was your experience like? Because that's an actual experience of navigating. I know you came out unscathed, but I think it'll be good for everyone to hear as well in terms of how you navigated that.
Today we manage roughly $500 million of portfolio. We have exposures to 30 sectors, 450 companies. We currently are running at a gross non-performing asset of 0.25%, that is 0.25% across the portfolio. We have not restructured a single asset, and we have possibly written off only one asset since the inception of the company. That's been our experience so far.
Fantastic, Vineet. I think I'm sure it'll go at least some way in reassuring people who are on the call today to assess and look at this asset class a lot more closely. Thank you. For you now, Hitesh, again, a similar question on, how do you, while it's absolutely true that there may be earning profiles of companies which are a lot more secular in nature, and with the right investment horizon, perhaps, the market price volatility, price performance volatility will be a lot lower. But when you look at constructing the portfolio, how do you sort of manage the risk largely around volatility and capital erosion?
Right. I am just going to, follow the footsteps of Rajesh here, and will quote Warren Buffett one more time when he says, risk comes from not knowing what you're doing. Mm-hmm. And so it really matters, what our focus has been, and what my focus has been throughout my career, is to learn to become better and better investor, learn to, identify companies that are, they're in the right industries, the management is of high quality, there is integrity involved, the industry dynamics of the companies, which they belong to are favorable, and it is reflecting in the margin profiles and return profiles and so on. So by the way, it was also, if I actually would refer to the beautiful answer that two of the panelists give before me, Vinit and Rajesh, partly, by the way, it's music to my ears, in the sense that shorting, and in Vinit's case, as it described 5 pillars, as you can see, there is, as in US they talk about robo funds and robo selection and so on. Despite all that, there's significant amount of people overview involved in the credit selection, and so also in shorting, and then so in alternatives it's just assumed a lot more that for some reason a lot more technology involved, and security selection, there'll be some kind of automation to it. But in reality, as we can see here, among all the panelists, that there's significant amount of individual acumen, the teamwork goes into it. To answer your question, how do we go after alpha here? Is just to go, one interesting reality about India is that if you take a Bloomberg classification or a GICS industry classification, out of 61 industries that exist as they classify them in India, across entire Indian market, bucket them into 61 industries. Just 16 of them, 16 out of 61, account for 75% of the instance of outperformance. So when you look at the best industry in India over the last 25, 30 years, it has been, for example, been commercial banking, private commercial banking. And then that is what we have witnessed over a long period of time. In IT and pharma and FMCG. So when we use those words colloquially that the industry are good, I mean, the evidence shows, as we perform the studies on them, that there are wonderful, companies in industry with positive dynamics. And conversely, as I think about, those 45 industries that just account for 25%, I mean, companies with great brands and, at one point in airline or in hotels or in textiles or in retail, retail garment brand owning and so on, but there are no investor returns there, right? So our focus is therefore to be in those industries where the incumbent sustainable advantage has a lastingness to it. It will be there for a while. So that is what we care about really. And that by itself takes care of substantial amount of risk management. So we would perform all the tests of the risk management process on our portfolios, but we are not driven by it. I mean, we are driven by the fact that which business in India, which company in India are going to create most value in the coming years, right? Investing is about future, in the sense that what's going to happen as I speak with you today. What I care about is what's going to happen in 23, 24, and 25. That is what I care about. And that is what my investors care about. And inside of that, we wouldn't be much interested in companies, based on their past laurels, but we would be looking at out of this 16, they are not constant, which are the industries where the dynamic is becoming better. Telecom at one point in time had a phenomenal dynamic. If you start with 95 and, probably next 15 years, and then it became an ordinary industry from a shareholder standpoint, right?
Thanks, Hitesh, because I think now Aditya is going to tell me that I've run out of time, but I still want to ask this last question to Rajesh on the risk management part of it for long shot. It's less understood and therefore even more critical. But I don't know if we have the time for it. If we have, Rajesh would like to go ahead.
Sure. I think it starts with the DNA of the fund manager itself. Show me a portfolio and I'll tell you the risk thought process of really the fund manager. And I think temperament is one of the most important things in investing, whether it's in fixed income or whether it's in equity or any other class of investing. So I think when we look at our portfolio, I think we look for the type of businesses that we would invest in. So one way to kind of dumb it down is look, whether our preference is really for predictable growth, multi-year growth opportunities. That by itself gives us a margin of safety when we are looking at companies. Now juxtapose that with what I'm saying is, let's say, more cyclical oriented, highly leveraged type of opportunities. So that's one way of kind of looking at it in a very simplistic way. You diversify in terms of companies, how sensitive they are to economic cycles, That's another way to look at it. How liquid is our portfolio? That's extremely important, given that we run a long short portfolio. All of that, and stop losses, right? If I have to kind of summarize that quickly, but stop losses are also equally important, as we look at that framework of risk management.
Thanks very much, Rajesh. I think I'm sure as we brace for volatility this year, the insights and how do you manage the strategy is also focusing on risk management. I'm sure it would have been a lot very reassuring for people on the call today.
Sure.
Aditya, are there any questions or anything?
Yeah, so I'll request audience to post questions. There's a request a question button on your screen on the right side. So if you could quickly post. This is last session, so we have some time. If the speakers are okay, giving 10, 15 extra minutes, I would be happy to take more questions. Couple of minutes, speakers. Till we start getting questions from the audience. Arpita, just a question, out of interest, because you're the only wealth person on this panel. Since we started working, especially over the last 7-8 years, how have you seen the preference in the among the investors when it comes to investing in alternative categories, different categories? Have you seen that change significantly over the years?
Yes, I have. When it started out, the awareness was a lot less, and because the awareness was less, the diffidence was a lot higher. I think the conversations have become a lot mainstream. It is reflected in the size of AIF overall industry from where it was getting to about whatever 3.5, 4 lakh crores. But I think more important, it's become central square in most of the client portfolios of a particular size and so on and so forth. I think mainstreaming of conversations is one part of it. And some of them have also evolved to be great treasury products, so absolute return, fixed income. So sophisticated investors. And I think third coincides also with the kind of customer segment, the single family offices have become serious pools of capital. And I think those also have the bandwidth and appreciation of the kind of risks that are associated with alternates. So it's come a long way, or obviously when you compare it to the size of the conventional first choice investing assets, which are 1 lakh crore plus, 100 lakh crore plus fixed deposits or mutual funds, it's still small. But from where we started out, and the momentum is extremely, extremely small. And I think it genuinely, in most of the cases, and you sort of heard about that today, it does generate, the investor experience has been largely positive. So it's become, obviously beyond a certain size, it doesn't really make sense. And with SEBI's new introduction of the accredited investor guidelines and so on and so forth, with people who are previously experienced and net worth are there, perhaps it will become simpler as well. So net, I think in short, a long way to go, but I think from where we started out, it's become a lot more mainstream. People don't shut out, that exotic would become toxic, and therefore I don't want to have that conversation. It's a part of every portfolio now.
Sure. So we have questions coming in. I think the first question, I'll take it up for Vinit. So Vinit, at Vivriti Capital, what are you looking at right now? What are the focus areas and what are your future plans?
At Deviated Capital, we are here to build the performing credit market. We are doing two ways. We have a lending company and we have an asset management company that are both looking to raise capital and continue to grow our outreach. Today we add close to 20 companies a month. That pace is accelerating as our investment in technology scales up. Today we, as I said, manage north of $500 million of portfolio. That scale is also building up rapidly. We've doubled every year for the last 3 years. As we move forward, I think the next couple of years are going to be extremely exciting in terms of the kind of pools of capital that we can attract. We have the last few quarters raised capital from European investors, American investors, Middle Eastern investors who had always expected India to only offer 10% dollar returns and higher fixed income, right? So for the longest time, when you look at global markets, India has got bracketed with other BRICS countries which are offering very different yields to global investors. In the domestic market, what we kept hearing is that fixed income does not sell at below 10% post-tax, right? So we would love to prove both these constituents wrong. The performing credit space actually is much lower risk. That's what we truly believe if handled well. And therefore, in both markets, we would like to deepen participation. The domestic market, deepen participation from mutual funds to performing credit alternate funds. And in the global markets, deepen participation into the Indian performing credit market. That's what's keeping us busy.
Sure. Next question for Rajesh. Rajesh, what trends are emerging in the Cat 3 long short equity space? Any comments?
So I think, there are two basic structures in the long short space. One is really the absolute return, and people tend to kind of think of all the funds as similar, but they are not. There are two categories of really absolute of long short funds. One are really the absolute return funds, and the second one are a little more equity oriented. I think there is greater acceptance of both, and I think the need for alternative investing, when I talk to clients, is rising. I think the conversation is resonating more and more with clients, the way I see it. Of course, it is being reflected in our growth of assets as well. But that's something that I can tell you that it's a very exciting time. And I think the need for these alternatives has never been greater. The point that Arpita was making and the way she started out, I think this change in financial and economic marketplace that has taken place, I think it is going to mean that assets which are going to be correlated and are going to be increasingly volatile as you move forward. So there are a lot of investors who now want a more risk-adjusted product, which can help them to navigate what is to come. So I think all of this conversation is resonating more and more, especially with more and more sophisticated investors.
Sure. So there's the question is to Rajesh, but I think it will be interesting to get views from everyone here. What have been some of your notable mistakes while pursuing your investment approach?
I will not know where to start. Too many.
So, okay. Anyone else would like to, give some insights?
No, I think in this fund itself, I think, look, when you emphasize downside protection, you have to compromise sometimes the upside opportunity. So we did a fantastic job, and I must admit, we did a fantastic job in protecting downside in February and March of 2020. But it meant that we wanted to, we still were conservative on the upside. We keep hearing, I've read so many investment books, and all of them say, if somebody gets the downside right, it's very difficult for him to get the upside right. And we proved that in 2020. So we were a little hesitant in the first quarter of 2020, even though valuations were in our favor. So that's something that when I look back, I look at that as something that we can learn from.
Sure.
And if I can add to that answer, if I may, the one interesting reality of the fund management and this cohort of fund managers is that there are a lot more errors and mistakes of omission than commission, which will always go unnoticed and more. True. So there is something that fits into your strategy, and it has become the target investment has become very attractive for you to buy, and for any reason whatsoever, one tends to miss out, and that doesn't get recorded typically, right? So other than everybody's year-end return, when we look at who did well and who did not, but there is not a fund manager anywhere who would not have committed enough and more errors of omission.
Sure, I can see one more question here. One sec, guys.
If I can add maybe a mistake in hindsight, Aditya.
Sure. Please. In fact,
we are a conservative house, and therefore fixed income experience has, I think, largely been fantastic for our clients. But obviously, we didn't see the ferocity with which the markets, especially the initial part of the pickup that happened. So while we were able to hold our clients from jumping out in that huge volatility where it seemed like market, things were coming to an end. But in hindsight, stepping up allocations and so on and so forth would have been managed.
You just made me feel a little better. Thank you.
How important is to look at max drawdowns while comparing long-short funds?
No, absolutely. I would say the most important. So when we kind of tell people how they should be evaluating long-short equity funds, I think the three things we tell them is, apart from gross return, because people just tend to look at gross return. Apart from gross return, look at drawdowns, because the entire objective of investing in a long-short fund is how much am I going to fall back, right, in my history. So that's the second thing that you look at. What is the maximum drawdown I have had relative to other funds? And the third part, because we are AIF structures and taxed at the fund level, the third thing that you should look for is how am I taxed? What is my rate of tax? So those three elements are extremely important. Of course, if you are a little bit more sophisticated, we encourage them to look at the DNA, the risk management practices, some portfolio construct, transparency, all of that. But I think those three things are the three things that are pointed out are extremely important, and that's what we guide them when they're evaluating different long-short equity funds.
I would echo what Rajesh said. As a house that continuously diligences ideas like these, I think the drawdown is the single most important measure of volatility where it makes it real. So clearly the most important metric that one should evaluate.
Sure. There's a question for Vinit. Vinit, debt markets globally are 3 times bigger than equity markets. In India, somehow they're yet to catch up. So what are funds like Vivriti doing to create more awareness among the right investors and clients?
That is my everyday job. everyday job to constantly give a sense of. So we're working at it at I would say 3 levels. The first level is like everything in India, it goes to the regulator, right? So our engagement with the regulator is very high to work on corporate bond markets, to work on a framework for credit funds within the alternative investment fund framework, as well as to work on how we can build infrastructure for listing and better tradability, how to build more robust frameworks for securitization. So for each debt product, how to build more clarity. The second is investor awareness. We engage actively with every potential constituent of the market, be it institutional, be it HNI, be it offshore, be it domestic, etc. The key barriers that we have naturally seen is extremely high information asymmetry. The so-called private space today has extremely poor disclosures, and that's really hurt the quality of capital coming into the country. The third level is really about product structuring, right? And that's been a very interesting path for us. For example, as I said, the spread between BBB and AAA is 8%. Now, if I add a layer of credit enhancement that allows us to, dampen the risk and improve the rating from BBB to even AA, right? I lose perhaps 3% in the process or 4% in the process, which still gives me a paper that is offering a significant premium to standalone AA in the market, right? So so how do we translate the opportunity to an exposure that can at least allow a pool of capital to take baby steps into India, right? This is something we have deployed quite successfully. It's given us fairly rich rewards in terms of getting insurance balance sheets to participate, in getting international balance sheets to participate, and build more comfort. And the hope is that the more you do it, the more you start moving into standalone issuances over time, as issuers build more capital market risk. I did miss one thing. I think the one last thing that we will all have to actively do in this market, anybody who's in debt, is also to build issuer awareness and governance, right? There are tons of norms on what you have to do if you have to issue a listed bond, right from the level of governance you need to have, your auditors, to related party transactions, etc., etc. That's not simple. That's not simple, and it is no secret why a lot of unlisted bonds get issued in India, right? So I think that's an area where all of us in the debt markets have to work actively.
Sure. Panelists, I can already see a few more questions coming in. How much time do we have? Can we have another 5, 7, 10 minutes of this discussion? Any of you have to leave? Because we already over our designated time.
About maybe max of 10 minutes. Yeah, from me. I'm sure the panelists are, they can decide for themselves.
5 minutes is
Sure. So we'll try to quickly take last 2-3 questions, guys. Question to Arpita. Arpita, how do you see the accredited investor concept making any major changes in the way you're going about pitching AIFs?
See, accredited investor is actually a global accreditation for almost all products which are considered a little more exotic. So this, from how will it impact I think it needs to be thought through carefully, because from what does an investor get by being a accredited investor, and what is therefore the trade-off. So so there's a process for it, and there is a certain net worth and income criteria, as is the norm globally. But I think unless the investors are really sophisticated and understand the risks of it, as a sophisticated accredited investor, you may not have the same kind of access to or a same kind of investor protection. So one part of being an accredited investor is your financial net worth, and therefore your ability to take a loss. But I think more important is also your prior experience with such investments. So it is once you are onboarded as an accredited investor, the norms and the minimum amounts for AIFs, for example, for category 2 and 3 is 1 crore, and PMS is whatever it is, may not apply. So it gives you a leeway from that point. But I think investors should think about it very carefully. Unless they are extremely well versed with these investments, they would be, they would not have, in case of not a great experience with the product, they wouldn't have access to the same kind of investor grievances that a regular investor will have. So it's good. It's early. It will evolve. Globally, it's a function of both, which is your net worth and also your investing experience. I think the second one should get incorporated.
Sure. Again, a question to the panel: how relevant is to compare the post-tax returns while comparing long-short funds?
I'll just take a minute before Rajesh gets a full go at it. Extremely important. Because ultimately, I think an investor doesn't care which structure he is in. And I'm talking for someone, again, who evaluates competing investment options and looks at a portfolio construction. Net, everything is on a post-tax basis. So whatever be the structure, a PMS or a direct equity or an AIF or any other structure, post-tax basis, for the risk that you've taken, what is your return, compensation is ultimately where the rubber meets the road. So a one-word answer, very, very important. But Rajesh, for you.
No, I think you've kind of articulated very well. It's extremely important. Nothing to add.
Hitesh, you want to say something? Should I? Okay. No. Question to all the three fund guys here. How would an investor in your fund know that you have deviated from your intended strategy?
Well, they get a lot of reporting, as they should, as they deserve to get. And so from the reporting, it's pretty evident. I mean, on the contrary, one prides oneself in writing to investors and communicating, through monthly fact sheets, quarterly updates, and so on, that, what is happening in the fund and, what your inside of your strategy, how are things evolving and what you've been doing and so on. So that So it's a communication that take care of things.
Sure. So I think I'll just take a last question, and all four of you can answer for this. How do you see the investment sentiments playing out over the next year or so?
That's an easy question for Arpita. Please go ahead.
I mean, it'll be great to have a quick bite from each one of you in this.
Obviously, I think the the expectations will have to be a lot more tepid and moderate, especially coming off a near vertical sort of an equity market experience from last year. So definitely a lot more, especially for India investors. I think medium term, we could debate at length, but largely, I think most of us would agree the outlook is very constructive. But whatever is happening globally and it's actually a reset after a very, very long time. It will play out in asset class volatility across. So, from a return expectation across conventional asset classes, a lot more tepid, a lot more calibrated, coming off what happened in the last 2 years. I would be a lot more conscious and calibrated about how the risk portfolios in the risks plays out in the portfolios. That said, equities as an asset class, absolutely not the time to get out of it and sit out of it, because and there's I'm sure there's a huge amount of literature around that. So ability to catch up once you're out of it and time and all that doesn't really happen. So stay invested, but be prepared for a very, very bumpy ride. And some of the strategies that got talked about here maybe deserve a place to be in the portfolio.
So I'll just add one follow-on question and each of you can answer that while answering this one. So Arpita, I mean, of course, you being a wealth person, you're neutral to all the asset classes. But if it is one asset class that you have to put your own money today, what is it going to be?
Actually, it'll be equities. It'll be long only equities. But I'll close my eyes and not look at the portfolio statements for a while.
Super. Vinith, the first question, I mean, the investment sentiment over the next 1 year, and other than your own asset class, if you had to choose one more, what will that be to put your own money?
So the answer for us for the performing credit side, I think there are two parts of this. One is the rates macro, one is the credit macro. The rates macro today is that rates are increasing, no doubt. People have stopped speaking about transient inflation. So inflation is there to stay. The rates are going to go up. And when rates go up, duration play goes away. The case for longer holding periods starts getting stronger and stronger as we go through the rate increase cycle, right? Which clearly favors strategies like ours, which are long only hold to maturity. We are not running a trading strategy at all. The credit macro is actually even better because we're coming off the deepest possible situation that we could have seen, which is COVID wave 1, wave 2, and wave 3, and companies that have survived this have to have a lot to speak for themselves, and therefore for us to be able to assess those companies from the best of times to the worst of times gives us a lot of perspective and an ability to lend. Lending in a bull market is tricky. Lending just after a bear market is much easier. So for both of these reasons, I think it's a great time to build portfolios and longer portfolios that can give stable fixed income returns over a longish period. Where would I invest? Frankly, I don't understand anything but debt. So I'll probably invest in FDs.
No, other than the asset you deal in, that's the question.
That's why I said FDs.
FD is okay.
It's the same family, I would say, but no. Yeah, Hitesh.
From sentiment standpoint, so what we have really observed is, the past returns have really mattered to investors. And for example, as we look today in 2022, 10-year return and I'm just going to use the mutual fund return as a proxy because there is no better proxy than them, is that, there are average 16-17% routinely in many of the blue chip funds. There are 18-19% returns on a 10-year basis in many of the small and mid cap funds and so on. 5-year returns, again, fantastic. Trailing 5 years return, trailing 3-year returns. So that has been driving. So sentiment from industry, for investors has been good. Retail investor in India has been good for the market, has been good. And it will continue to be good simply because of that. Going forward, what are we looking at, right? So we are looking at for the next year, 8% GDP growth, 7.5 to 8%, which is fantastic, followed by, very likely 6.5 to 7%. And there'll be election year and, more spending and so on. So we are just looking at, good quality corporate growth. And if the inflation is a little bit higher, but hopefully not too high, some Goldilocks numbers, in which case, the revenue growth of the corporates will be stronger as well. So that is, mostly good, as I would put in my view. I would worry about, what's happening in Europe right now from the external standpoint between Russia and Ukraine, and, what is the fallout of that. And related or not related to that, oil prices, because that really affects us, and the inflation here in India. So, I mean, among, if I were to name two things I would worry about that can put some dent to this sentiment, there are these two for now, for me. In addition, of course, to what is covered already, is the interest rate hikes.
Sure. Rajesh?
So, I think I'm glad I'm running a long short equity fund because, I think in my view, the primary trend for equity markets was entirely driven by this huge expansion in balance sheet of central bankers, which had the impact of, collapsing interest rates, negative real rates, and, all that money moving into the equity asset class. And equity as an asset class got re-rated, right? Now there is clear, as Vinita also pointed out, that there is a clear sentiment towards reversing that. And I don't know the intensity of the reversal, right? Because that is an uncertain number. Although we can say that for sure that the real rates in the United States are the lowest or the highest rather since at least the 1940s and the 1950s, if not earlier. So we don't know the intensity of that, and therefore the implications for equity markets. I have a lot of questions. Has the Indian markets already come out of a bubble? It's very unusual to see retail enthusiasm the way that we saw at a start of an economic cycle, right? So these are the impacts of the monetary expansion that has happened. Now, so if this were to ameliorate, right, if this inflation were to come off, it's transitory, and we'll know that more in the back end because the front end, there seems to be more risk. And even if that were to come down, I think it's more towards the back end. Then I think the Indian investor would say, you're looking at a $3 trillion economy, which is going to grow at the fastest rate in the world, right? And we are at the beginning of a credit and a corporate earning cycle, right? So it's for the enthusiasm for Indian equity is going to be fairly high. If FIs have already sold, 140,000 odd crores, and if that were to turn, some of this money will have to flow back in. So I'm glad that I have a tactical book. I can react to some of this, at a later date, after evaluating how some of these trends pan out.
Sure.
But if I could just add one point,
Yeah.
while I said long only equity, I just one nuance to that, there are certain kind of strategies and certain kind of companies that have worked very well in the last decade or so. I think, getting in here, there is a change in the way the profit pools of organized and listed companies are going to happen. So long only equities for sure, but I think the strategies and a lot more economy facing versus the past decades are making the mistake of expecting what you saw last decade and the kind of companies that's something I would stay away from. So I think just the kind of companies and kind of funds and kind of portfolios that I would pick would be different, but long only equities for sure.